Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Let's compare the advantages and disadvantages of long-term and short-term investing so you can decide which strategy works best for you. Common assets in short-term portfolios. Short-term investors typically focus on assets that are highly liquid. This means they can be bought and sold quickly without significantly affecting their price. Speed and availability are key. Some common assets used in short-term strategies include highly liquid stocks. These are shares in major companies that are traded very frequently, making it easy to enter and exit positions. Options. These are contracts that give the holder the right, but not the obligation, to buy or sell an asset at a set price by a certain date. They can offer quick leverage. Futures. These are agreements to buy or sell an asset at a future date at a predetermined price. They are often used for commodities or stock indexes. Currency pairs, Forex. Trading different currencies like USD, EUR, is very popular for short-term speculation due to high liquidity and constant price fluctuations. Commodities. Raw materials such as oil, gold, or silver can be traded short-term, especially futures contracts tied to their prices. Advantages of short-term investing. Why would someone choose to trade short-term? There are certain appeals, especially for those who enjoy fast-paced action and seek immediate results. Here are some potential benefits: quick profits. If done successfully, short-term trading can yield profits much faster than traditional long-term investing. Greater flexibility. You are not locked into long-term commitments. This allows you to react quickly to changing market conditions. Capitalizing on immediate market trends. Short-term traders can jump on sudden price movements caused by news, economic reports, or company announcements. Disadvantages and risks of short-term investing. While the idea of quick gains sounds appealing, short-term investing carries significant risks. It is not for everyone, and many beginners find it very challenging. Consider these important drawbacks: high transaction costs. Frequent buying and selling leads to more fees and commissions, which can eat into profits. Increased exposure to market volatility. Rapid price swings, which short-term traders try to profit from, can also lead to sudden and significant losses. Need for constant monitoring. This strategy demands active engagement. You must watch the markets almost constantly during trading hours. Potential for substantial losses. A few bad trades can quickly wipe out capital. The risk of losing a significant portion of your investment is high. Psychological stress. The fast pace, quick decisions, and potential for rapid losses can be incredibly stressful and emotionally draining. Key differences and considerations for investors. When you're weighing long-term versus short-term investing, it's about more than just a time frame. You need to look at your personal comfort with risk, how taxes might affect your earnings, what you know about the market, and your financial goals. Let's break down these critical areas to help you decide which path makes sense for you. Risk tolerance and investor psychology. Both long-term and short-term investing carry risks, but they impact you differently. Long-term investing needs a calm mindset. You'll see your investments go up and down with the market. Think of it like a roller coaster. There are drops, but you trust it will climb back up over time. This approach requires patience and the ability to ignore daily market noise. Short-term investing is a different story. It demands a high tolerance for quick price changes. A small market shift can mean big gains or losses in moments. Imagine being a day trader. You face constant fast decisions and the pressure of losing money quickly. This can be very stressful and test your emotional limits. Tax implications and capital gains. Taxes play a significant role in your net returns. The government often treats gains from short-term and long-term investments differently. Here's how it generally works. Short-term capital gains. These are profits from assets held for 1 year or less. They are usually taxed at your ordinary income tax rate. This rate can be higher than long-term rates, especially for those with higher incomes. Long-term capital gains. These are profits from assets held for more than 1 year. They typically receive preferential tax rates, which are often lower than ordinary income tax rates. This tax difference means you could keep more of your profits when you invest for the long term. Required knowledge and time commitment. Your chosen strategy will dictate how much you need to know and how much time you spend on your investments. Short-term investing often requires deep knowledge of technical analysis. You might study charts, trading patterns, and market indicators. It also demands a huge time commitment. Traders often spend hours each day watching the market, making quick decisions. Long-term investing focuses more on fundamental analysis. This means researching a company's health, its financial statements, and its growth prospects. Once you've made your investment, it requires less frequent monitoring. You might check in once a quarter or even annually, making adjustments only when necessary. Goals and financial planning. Your financial goals are a major factor in choosing an investment style. Long-term and short-term strategies serve different purposes. Long-term investing usually aligns with significant life goals, such as saving for retirement. Building a nest egg that grows over decades. A down payment on a home. Saving enough to buy a house in several years. Your children's education. Funding college tuition in the future. Short-term investing often suits more immediate financial needs or aims to capitalize on rapid market shifts. It might be used for generating quick income, trying to make money from price changes in a brief period, funding a specific, smaller expense, saving for a vacation or a new gadget in the near future, capitalizing on sudden market movements, taking advantage of a stock's sudden surge or drop. The best path truly depends on you. Think about your comfort with risk, how long you can let your money grow, and what you hope to achieve. Consider your available time and market knowledge, too. For guidance that aligns with your unique situation, talking with a financial advisor is a smart next step. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.